Assessing the solvency for a microinsurer is similar to assessing the solvency for a conventional insurer. The insurance supervisor will usually assess the solvency of a microinsurer when there is a dedicated or a separate license for microinsurance business in that jurisdiction. Also, it's important to assess whether the microinsurance business unit of a conventional insurer has access to sufficient funds to be able to carry out its business objectives. When considering the solvency of a microinsurer, the supervisor will assess whether there are sufficient assets to cover both the technical provisions and the minimum capital requirements for microinsurance business or inclusive insurance business. When assessing the assets for inclusive insurance business, we need to consider the types of products that are sold for inclusive insurance. These products are generally short-term products and may be limited to a 12-month period. This means that liquid and secure assets are most suitable for inclusive insurance business. For example, deposits in banking institutions and possibly short-term government bonds. The insurance supervisor will also assess whether technical provisions and the minimum capital required are calculated according to the regulatory requirements. For reinsurance, we may expect that inclusive insurance business would have lower levels of reinsurance compared to conventional insurance business because the sum assured is lower for inclusive insurance business. But there is still a chance of an accumulation of claims or a large number of claims that may occur at the same time due to a catastrophe event. This is particularly a concern for agricultural insurance. We may see that inclusive insurance business has catastrophe cover, and we need to be particularly careful that there is sufficient cover to cover an accumulation of claims for agricultural business that is exposed to weather-related events.